Hey guys, this is Jim Merritt with QuickTrainer Incorporated in beautiful Wilmington, North Carolina. And this video is going to discuss the steps that you need to take when you purchase a new asset that is going to be financed. So you're purchasing, for instance, I'm going to do an example of you've purchased a vehicle, a truck. And that truck, in my scenario, is you put a down payment on the truck and you're financing the remaining balance. So let me just start by saying it is not appropriate to record those payments on that vehicle to the profit and loss statement. I see this way too often where payments are being made and they're put on the profit and loss statement, as auto payments, and that is not proper. Why? Because the financed balance is a liability, and so it belongs on the balance sheet. Also, the financed or the vehicle that you're buying also needs to be recorded as a capital asset or a fixed asset. And then it gets depreciated over its useful life, and then sometimes under what's referred to as Section 179 if the vehicle meets the criteria and you have enough profit, but that's a discussion for another day. So let's just start by looking at the chart of accounts. Right here is a fixed asset account for auto and trucks. And down in this section I've got one notes payable account for John Deere Finance, but we are going to buy a vehicle and we're going to create another long-term liability account for that. So in order to do that, we need to have the long-term liability account there, and we'll create that in this scenario. So let's just start with a scenario where you have purchased, or not purchased, but you have put a down payment on a vehicle, and you wrote check 1009, and let's say you did that on 6/1, okay, and you did it to Bob King, GMC. Okay, and let's say you put $1,000 down on a 2016 GMAC, whatever the model is. We'll just say truck, and we'll spell it correctly even. Okay, so you're going to record it to this account right here. Again, that's a fixed asset account. And always a good idea to put a memo in in this section. I am more concerned about the memo being right here. I just happen to put it in both places, but this is where you really need to put the memo that describes what is this. Okay, and we would probably put the model number, etc. Sorry, I just don't know what model numbers are for GMAC trucks, and that would probably be GMC truck and not GMAC truck. Sorry. All right, so we close that, and if we look now, we can see there's the $1,000 that we put down, okay? But let's say that this was really a $35,000 truck. Well, you've still got a $34,000 balance financed on that truck in this scenario. And there's a couple ways you can go about doing this. I'm just going to show you one of two ways that I can think of. I'm just going to show you one way, which is the most common way, and that is to do it through a journal entry. And you'll find under company, make general journal entries. This is a journal entry, and this is how you go about getting both the debit side and the credit side of a transaction when it didn't come out of the checking account or it wasn't a credit card transaction. So we'll date it for 6/1 again. I don't care about the number. We'll say 1860 is the account, so that's going to be the debit. That's going to show the $34,000 balance that we owe. And again, we'll put 2016 GMC truck, and that was from Bob King. Okay, that we bought the truck. Sorry. And look at that, I even spelled Bob King wrong. So let's fix that real quick. Boy, this is not my best day in making a video, huh? But you're going to get the idea still. All right. So then the other side, the credit side of that is going to be that notes payable account that we need to create. So when I type in 2820, which is the next logical number, QuickBooks is going to say, I don't know what this account is. Would you like to set it up? And so I'll click set up, and then I'll come down to here and I'll click on long-term liability, and then I'm going to say N/P stands for notes payable, and GMAC Finance. And yes, it is GMAC this time, not GMC. It's GMAC Finance is the financing company. And that's going to be a sub-account of 2800 because now I've got more than one notes payable account, so I'm going to make it a sub-account. Okay. And that memo's fine. And here we will say GMAC Finance, because that is now the vendor in which we will make payments to on a regular basis. So understand, Bob King GMC, that's who we bought the truck from. That's who we gave the $1,000 down payment to. But now there's a finance company that stepped in and said, all right, I'm going to pay the $34,000 off to Bob King, give them their money, and now you the person financing, are going to make the regular payments on it. Okay, so we'll do a quick ad to get them in there as a vendor, GMAC Finance, and save and close. So now you can see there's the $35,000 on the under autos and trucks. Okay, and if we bought another vehicle, we would put it under the same account, and we'd have multiple vehicles under this account. That's cool. And then down here you can see here's our $34,000 balance on that finance loan we just set up. Now, as it's time to make payments to that, let's say we're making our first payment on 7/1, and we're making it to GMAC, and again, don't pay any attention to the amount of the payment. I'm just putting a number out there. Okay, let's just say it's $490. Okay, and so we're going to record that payment to GMAC Finance. Now, if you think about it, technically $490, if those were our monthly payments, not 100% of that, in fact hardly any of that at first, is paying down the principal of this loan. Okay, a large percentage is going to be interest. Okay, most people don't worry about that. They'll put 100% of it to the principal, and then at the end of the year we'll find out what the payoff of that loan is, and then we'll make an adjustment to adjust for the interest. So now that at the end of the year, that loan balance is reflected correctly for tax return purposes. Okay, so we could put in here, let's see, 2016 GMC truck payment, something along those lines. And up here, especially if you're printing checks from QuickBooks, you would put the account number. Okay, so that the account number would appear on the check. That's kind of the idea. And so now, as we record that, you can see, let me scoot this out to Okay, you can see now we've got the original $34,000, and we paid down the loan balance to $33,510. But again, that's not accurate because there is interest in that. If you want to obtain an amortization schedule and record each month's payment, as it is, if you want to split the principal and the interest out, let's just say for round numbers that $390 of this was principal and the remaining $100 was interest. We would do it like this. Or you could just say interest, actually. Okay, that's only if you want to record the interest and the principal each month. Again, a lot of people don't do that. There's absolutely nothing wrong with doing it. Where it can get a little complicated is if you start making additional principal payments, because when you start making additional principal payments, maybe instead of $490, maybe you paid $600. Okay, so now you've got $500 here, but you've got to recalculate the amortization schedule now because you're not paying as much interest. So yeah, it gets complicated. My advice is either do one of two things. Just keep it simple. Just apply 100% to the principal and then make the adjustment at the end of the year. Okay. In fact, let me just stop there. Do that. Okay. If you really want to get into the amortization of it, yeah, we can have a different conversation about that. All right. I hope that helps, guys. And just if you have any questions, feel free to comment. Feel free to shoot me an email at info@quicktrainer.biz. You can call us 910-338-0488. You can visit us on the web at www.quicktrainer.net. Make it a great day.